Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of today's video, I've got 5 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick off today's S&P analysis as we don't typically do, with the SPY technicals first, and then we'll jump into the S&P sectors. Thank you to everybody who left some feedback on last week's episode. Let me know what you think of the new updated format down below in the comments section today. So coming into this week's worth of trade, the primary focus should have been this balance area right here, because on Friday we had a firm breakdown and close underneath the bottom of the daily balance. So let's think about what quote unquote should have happened if the market was going to remain bearish. If the market were to remain bearish, we should have put in a lower high underneath. Sellers should not have allowed prices to come back into the box, and we would have continued on our merry way to the downside. One of the situations that we mentioned in the weekly watch list video on Sunday was the recapture of 360.75 triggers a look below and fail. We should target the top end of the balance range here, which was ultimately hit through the course of a gap in the overnight, but it was bullish on Monday, right? So point number 1 being here is that the sellers failed to do their job early on in the week. We had a balance area, we got a firm close underneath. Sellers should have been able to keep it underneath 360.75. That was not the case. So bullish data point number 1 stacks up because sellers couldn't do their job here. Bullish data point number 2. What happens on Tuesday's session? Big gap up, right? And it's a gap and go. There's no immediate knee-jerk reaction to close the gap underneath, and we're also now firmly moving away from the balance area to the upside. That is bullish data point number 2, and I would also add we closed firmly at the highs of Tuesday's session. Bullish data point number 3, what happened on today's session, right? We have an open right towards the bottom of the Tuesday range, which jeopardizes the gap fill, right? What happens? We breach Tuesday's low, we look into the gap where we know there's virtually no structure, right? There's very little structure there. So what should the sellers have done if the sellers were going to be strong? They should have closed the gap. Did that happen? Absolutely not. So what's that tell us about the sellers? They are weak. And even further than that, I would say that the buyers are strong because look at today's high. Technically, it's an outside bar. We made a lower low, but also a higher high. We got an early pullback and then rallied the remainder of the day to set a new higher high and closed relatively strong towards the upper third of today's range. Does it mean that we just blindly follow through to the upside into the remainder of the week? It does not necessarily mean that, but I would say that this is a pretty pitiful display of strength from any sellers who are looking for this market to roll over. They had their big opportunity on the breach of these lows right here, the balance range lows, and it simply did not happen for sellers. I would imagine that some of this has been fueled by short squeeze, but as long as we are over and this gap remains unfilled, I would just give you the number as 371 even. As long as we're above that, I would say that the sellers don't really have a firm grasp on price action up here. Now, again, it doesn't mean blind longs, but I just wouldn't be as aggressive of a seller given these market environments, okay? And I would also add, we do have the caveat that there will be non-farm payrolls and unemployment coming out on Friday, which we'll discuss in more detail on the TNX chart momentarily. But anyways, from a SPY price action perspective, I would say that this chart has to be more bullish than bearish based on all of the things that we've just outlined. Knowing that we are above the weekly expected move, we also have an overhead target here that's quite limited to the upside, right? So pushing it for new money longs might not be ideal here, but I also wouldn't be swinging for the fences looking for a complete breakdown in the S&P 500. So going forward, what's the most important objective to continue to monitor? Of course, it's staying within this range or moving higher if you're a bull. And if you're a bear, you want to see a big breakdown of the gap close here at 368.50. 368.50, if we can move back down underneath that, then my goodness, we just have nothing more than a volatile market, and we're moving back and forth through this balance range. Look below and fail, look above and fail. I mean, it would be all over the place, but it is on the table. So critical numbers to be watching. The most optimal bullish outcomes, as we just pointed out, consolidate here and move into the FOMC breakdown from there. That is bullish into the remainder of the week, and that target, by the way, is 382. On the downside, if we pull back, close the gap, and reverse off of it, that would be more neutral, and breaching that 368.50 that we just pointed out would technically trigger a look above and fail on the daily balance, and we could target the bottom end once again at 360.75. So be open to all possibilities, but based purely on price action and psychology, I would say that the buyers do have an upper hand from everything that we've just walked through. Let's continue and take a look at the sectors now, just really, rewinding back to our traditional format. Who was leading, who was losing, and where was the weight? Leading the pack today was energy, and energy has really put on an impressive display to the upside, which is fairly concerning because we know it's D for defensive and it's also L for a lightweight sector. So we don't really want this rally here, this small breakout, to be led by a lightweight sector, and currently it's looking like that's really kind of the case. In terms of the bottom of the barrel, it's actually going to be here, the XLU. There's this weird sorting thing with the percent from open, and you'll notice that they were at the bottom of the barrel, 0.96% to the downside. XLE, just I didn't say it out loud, but it was 2.11% to the upside. In terms of the heavier weighted sectors, where were they? So we've got the XLK, the heaviest weighted component of them all, the tech sector, up 1.17%. We've got the XLF Financials, second heaviest in our lineup, up 0.79%. And then the XLV, the healthcare sector, third heaviest weight in our lineup, second by market cap, up 0.98%. So still a pretty decent display with the tech sector being up towards the top of the list. But let's take a look at the structural charts and see how the trends are continuing to unfold and whether or not they support the idea that the bulls are in control here. So as you can see, energy up very, very aggressively and also above the top of this balance that we were discussing prior. Remember that we had rejection, break, retest, and held at first. We're above that 78.50. So this is not really a great look in my estimation to see the energy chart putting in so much work to the upside and leading the market rally higher. It's not really how we want to see this type of thing unfold. It would have been better for energy, as we pointed out in the past, to reject off of the gap fill, maybe just go a little bit higher and really stay sideways underneath that 78.50. So this does strike me as a bit of a red flag for the marketplace. Continue to monitor this. The worst thing that energy could do right now is continue to fuel a rally higher and take out these pivot highs in here, 82.85 and 85 even. Okay, so monitor those levels closely to the upside. I would say that things are starting to get a little bit extended here on the daily time frame, but it doesn't mean that prices can't continue higher. Again, carry this forward as a small red flag for the marketplace. Here's the XLK, the tech sector, right? The heaviest weighted component of them all. So let's spend some time thinking about it. Here is your June low. What has happened on the past 2 trading days? Obviously, we've gapped up and over that June low from underneath, which does strike me as a step in the right direction. And we've also got the bullish engulfer here on the XLK chart itself, with a failure from the sellers to go lower into the gap underneath us from Tuesday morning's gap up. So yes, psychologically and price action, bulls do seem to be in short-term control here, but I wouldn't say we're out of the woods yet unless we can clearly produce either further bull flag consolidation and breakout for a new higher high, or fill the gap and reverse off of it for an obvious higher low on the daily time frame chart. There's still the possibility that this could be building out a daily lower high from here to here to here to here. This could be a lower high if we reject off of it and cannot find a higher low. So do be mindful of that, but the chart would strike me as being more bullish than bearish into the remainder of the week, also accepting above the multi-day balance from right around in here. You want to see 125 hold if you are a bull, and if you're a bear, you want to see that fail and prices move back down to 122. Next up, we've got the XLY. What's going on in the consumer discretionary space? Not nearly as bullish as what we just saw in the XLK or the XLE for that matter, noting that here's your balance range, and we are not up and out of the balance range like what we just saw in all of the charts that have been presented in today's session. So knowing that, I would say a little bit of relative weakness here. Anything that just remains choppy in the box is exactly that, a little bit more neutral, not necessarily bullish for the market. If we can break out up and over 149.35, step in the right direction, and breakdowns obviously get bearish to the June low, looking at 137. Based on the structure of this chart, I would say, in the short term it is, we filled the gap and we reversed off of it and closed back inside of the day's range, and filling the gap required moving underneath the daily balance range. So this does strike me as slightly more bullish than bearish, but being in this range here, I've got to remain neutral until we can get firm price acceptance above or below both of those levels. And this is a heavier weighted sector, which is why we spent some time talking about it. XLV, second heaviest weight by market cap. Very, very, very impressed with what's been going on here. We've technically got like an hourly double bottom. We took out the neckline. We moved back above that 123 outside of the daily balance from down here. Remember, the daily balance originated from these 3 days. It looked like at first a failed back test, right? Look above and fail. Things weren't looking good, but complete turnaround over the past week's worth of trades so far. Knowing that we're accepting over 125, I would start to be more comfortable with scouting for a higher low to do something like this inside of the XLV, which of course is a bullish indication for the S&P 500. Now, where's the ideal line in the sand? We should not go back down underneath 123. But in a rainbows and butterflies situation, it's got to be 125, right? And we know that because it's the monthly balance lows, right? You could look at something that looks like this. If we can remain back above 125, it steps in the right direction. But again, are we out of the woods from the possibility of a daily lower high? It's still possible, right? You've got high, lower high. Could this be a lower high off of the 128 level? It's still on the table, but in the short term, you can certainly see how this is slightly more bullish than bearish, moving outside of this bear flag acceptance beneath 125. So just to boil it down to the very basics, ideal pullbacks in a rainbows and butterfly world hold 125 for a higher low, and then we're back off to the races to the upside. If we breach 125, your must hold area is 123 for a bounce. Anything under 123, kiss it goodbye. I think it was nothing more than just a bear rally pop. Maybe we get another down leg in the market after that. That's your XLV. Next up is communications, lighter weight sector, but nonetheless, we know it's been absolutely beaten down, well underneath the balance from up here. What's going on? Certainly filled the gap, staying outside of this balance range. So in the short term, yes, it is slightly more bullish than bearish. I would watch for closes or essentially price action tomorrow into the end of the week, essentially over 50.75 for the retest of the breakdown level from here at 52. And that's really the ideal location for the lower high based on a trend line, right? So watching 52 backtest like a hawk in the XLC, anything that remains in here is slightly more bullish than bearish, but it's got to be the break and sort of rally here to get bullish in the SPY itself. Just holding sideways won't really do a whole lot, and obviously breaking back down underneath 49.20 is bearish. XLF, very impressive move as well, much more of an inside bar on today's session, completely contained, did not produce a higher high or a lower low, meaning that there was no move towards the gap, which is bullish, and we've also just closed up towards the top, the upper third of the outside bar, the container bar, which of course was Tuesday. So going forward, how do you play this? Very simple, long over the top, short underneath the bottom, and the most attractive part about a short here is that we do have gap structure to be trading for. Now, as we've seen in almost everything else, most gaps either filled partially or filled and reversed off of it. So XLF, if it does move lower, I would just not be swinging for the fences and aiming for here. I would say, okay, it's very reasonable that the XLF might repair structure, find a higher low, and then move back to the upside. If we can get back above 3250, an incredibly bullish indication for the S&P itself, because that is where we broke down from the FOMC. Getting back above that with a higher low would start to change structure here, and although very sloppy, could start to build out something that looks like this, inverted head and shoulders for a trend change on the daily time frame, something to be mindful of. Next, we've got the XLI, lighter weight sector. Certainly just as bullish as most other things we've seen thus far. No gap fill underneath, hanging out as an inside bar, a little bit of a higher high, but inside bar nonetheless. If we can take out this 88.20, look for bullish pressure. If we move lower into the gap, I wouldn't be bearish on this unless we breach and get acceptance under 85. Next up is XLB. You'll notice we're moving a little bit faster through the lightweight sectors. XLB materials, extremely lightweight sector. It's like 2.5% of the S&Ps. Nonetheless, still bullish, not really above this breakdown level yet, but above the FOMC breakdown. So steps in the right direction, but unfortunately it's not going to make or break your S&P 500. Even if it does continue higher, that's great. It's just very, very slight bullish pressure for the market, and because we're not making aggressive new lower lows, I would not read into it too much from the bear perspective. Here's the XLU just going sideways at the lows, which makes complete sense, noting that we fell off of an absolute cliff, getting a little bit of a dead cat bounce and some volatility down here. I would just watch out and say, okay, anything that's over 69 is just acceptable in this range. You want to see it go sideways, and further breakdowns, again, we're only concerned on the making of new lower lows beneath 64.57. Any playing around in here is fine, remembering that this is a D for defensive sector. We do not want it leading the pack. So as it consolidates and chops around, it's a great look for the market. Next up, we've got the XLRE for real estate. This one basically the same as utilities, just from a sector perspective and analysis and impact of the S&P 500. Sideways in this box is fine. Aggressive new lower lows, definitely more of a red flag, especially noting that we've already been so far and deep underneath the June lows. So I would be watching 35.50 like a hawk, but anything that's sideways here is more acceptable. And of course, if we were to take out the top, it's all about the back test of 39 roughly. So what happens there is a decent thing to be watching out for. If we roll over off of it, might be a place to start looking for short shorts in REITs, not necessarily the broad market itself, because this is such a lightweight sector. Next up is the XLP Consumer Staples. What's going on in staples? Again, more sideways. Remember that this is D for defensive. So again, not the end of the world to see this down here at the lows going sideways, not doing a whole lot. If it were to pick back up, it wouldn't be the end of the world. It's certainly not leading the charge on a relative basis compared to what we just saw in the XLK, XLV, or even the XLF, the three heaviest weighted components. So chopping around here is fine. I would say that the chart would suggest more bullish activity based on the hammer closing the gap and then moving back inside of the Tuesday range. If we take out the highs, of course, you're starting to look for 70 into the remainder of this upcoming week. So overall, the sectors do look fairly good, but we're not entirely out of the woods just yet. Here is the ratio breakdown. If you don't know what this is, top right-hand corner tells you how to set it up, and we'll talk about the interpretation right now. Here we go. Top four sectors are the heavyweight risk-on sectors. Notice that your XLK, although very nuanced, did put in a higher low, so there's the possibility of a higher low double bottom, and of course would require some acceptance over this 0.34 ratio. So we'll see if that can happen. Remember that because this is the heaviest weighted component of the S&P 500, we're not really out of the woods from a risk-on perspective until this can start trending higher or get price acceptance or ratio acceptance above the gold line, which is the 50 SMA. So still a concern here in the XLK. XLV looks great back over 125. XLY, a little bit more sideways than what we'd like to see, but it's been trending and pulling its weight for quite some time now, so it's not the end of the world. And then in the XLF, also picking up here, right back above its upward sloping 50 SMA after this pullback right here. So overall, if the XLK can kick into gear, we would be in a risk-on environment just based on the ratio grid. Now, obviously, you can make what you will of the weekly and monthly trend in the SPY itself, but just based on the ratios, things don't look half that bad. Here we go in the bottom four, the risk-off sectors. What are these indicating? XLP, down low, A-OK. Energy, as we pointed out, this is the biggest red flag, I would say, paired with the weakness in the XLK on a relative basis so far. Pair this XLE ratio with this XLK ratio, and that should be giving you, I'm still not quite all that bullish, right? Those are the two biggest concerns. This as the risk off and this is the risk on are not really cooperating. XLU, though, does look great, and real estate, as we pointed out, has looked great for quite some time now. So overall, two things that we got to focus on, continue to monitor those two ratios. When and if we can make the turn there, so XLE lower and XLK higher, maybe we get more follow-through in the S&P 500. Something to think about there. Next up, we'll move on over to the TNX and talk about what we've got on the economic calendar. So as we know, Fed has been continuously aggressive with rate hikes and saying that we will be higher for longer, which of course the market does not like. But one thing that the Fed has been explicit about is that they're very closely monitoring the jobs market, and we are getting some pretty critical data on Friday. So here is the economic calendar, courtesy of forexfactory.com, and what you'll notice is that on Friday, at 8:30, we'll be live covering it on the live stream here. We'll get hourly earnings, non-farm employment, and the unemployment rate. Those things are really what the Fed will be keying into to determine whether or not they have gone too far with their rate hike policy. If they start to notice that the jobs market is really taking a beating, they will probably lay off the gas pedal and tone down the rate hikes. They don't want to completely destroy the jobs market, but they do want to put some pressure on equities. So what does that mean? Why are we talking about it on the TNX? I wouldn't be surprised to if we get bad jobs data, meaning that the jobs market is suffering, I wouldn't be surprised to see rates kind of taper off a little bit and go sideways into the end of the week, which would be a bullish thing for the equity markets in the short term, right? So watch for this to possibly come a little bit lower and your XLK to pick up the slack and move to the upside. It's just one scenario to think about. The jobs numbers could come in fine. There could be no issue. And who knows? Maybe the market doesn't like that because we're forecasting that the Fed will likely continue to be as aggressive as they have been in the past couple of hike cycles. Again, a little bit fundamental for my personal liking. It's not like I'm making big market bets based on this information, but it's another way to be thinking about the market from, again, more of the fundamental perspective. There's probably a proper blend of fundamentals and technicals. It's an awareness thing, right? You don't want to be putting on huge risk ahead of these announcements. You shouldn't be surprised when and if things change, even based on bad news or good news. It's just something I want you to be mindful of. So that is your TNX analysis. Let's continue along and take a look at volatility, which is going to be our VIX. And obviously, as we've been getting a little bit of a rally, the VIX has been coming in, but has it come in aggressively? Are we seeing something like this? Are we seeing something like this? Not really, right? So I don't think that we're completely out of the woods from the VIX perspective. Could this be all we get? Could we see something over time? Looks like this is a trickle back lower. It's possible. You pair that with, again, a jobs market that starts hurting. Maybe the Fed tapers back a little bit and says, okay, maybe we went too far, and your VIX comes back down as the SPY continues higher. You can see, if we scrunch this chart up, it wouldn't be unreasonable for this to be the top in the VIX. It's not like every time we get a capitulation bottom, it's around 40. We just use 40 and that like 38 handle as the most extreme version to indicate that there still could be some possible risk on the table. But again, it's not out of the ordinary for this to kind of be the top in the VIX. So just something to consider, but we're not moving as lower we're not moving lower as aggressively as you might think, given the bullish days we've seen in the marketplace, is what I'm getting at here in the VIX. And that's still going to be evident in the VVIX, right? Notice that it's like, okay, we saw 2 days of upside activity and all of a sudden everybody thinks we're out of the woods. This is aggressively lower, but that's not really what we wanted to see. Right? We wanted to see the VVIX, remain elevated and people still prepared for upside and downside, right? Basically protecting any sort of move that could happen in the marketplace. So this is just an indication that overall we are opening ourselves back up to that sort of flood effect. If no one's buying SPY puts, and VIX calls, and all of a sudden, let's say that the jobs numbers are fine and it's an indication that the Fed will continue to raise rates aggressively, then this is going to have to spike again, right? Because everybody's rushing into SPY puts and VIX calls all at the same time, creating excess demand. Just something to be thinking about. The one positive from a volatility standpoint is if we take a look at the VX futures, which are just the VIX futures, right? And we go on over to the trade tab, we'll drop it down so we can see, the active contract and the November contract. So October and November, look at that. We are out of backwardation by just a hair. It's not a big contango, but we are out of backwardation, meaning that the market's starting to recognize that, okay, there's probably more risk on the horizon, in the future, as opposed to right now in this current day and time. So this is a step in the right direction in terms of volatility settling down, but it's not massive. Notice that we've got 73 and 87. It's not like, we're dealing with a 50-cent contango here inside of the VIX future. So just something to be mindful of, but a step in the right direction for things to start settling down into the coming week. That's what I've got from that perspective. What else do I have to share with you? Here we go with the market internals. If you don't know what this screen is, top right-hand corner tells you what it is, how to set it up, how it'll help you make better intraday trading decisions, and here is the interpretation. So one thing I will continue to point out that is just pretty detrimental to the market is the overcorrelated state. Right? It's buy everything, buy everything, buy everything. And today, on the open at least, it was sell everything, sell everything, sell everything. Now, granted, we did neutralize just a little bit, but seeing these overcorrelated reads well above 2,000 and well beneath negative 2,000 would be an indication to me that, sure, the VIX might be coming down a little bit. We might be out of backwardation. But if this is going to be as aggressive as this, buy everything, sell everything, buy everything, sell everything, it's still just an obvious indication of volatility. So keep that in mind as you start seeing these, crazy back-to-back reads. In terms of our volume on today's session, notice that it was fairly muted, slight outflows, but nothing significant. And on the two biggest days, which I would say is Monday and Tuesday to the upside, where we made the most progress, we did have significant inflows to the market, meaning that there was quite a bit of true buying going on market-wide. It was not just isolated to some of the big names. Ticks, just confirming again, nice positive indications on Monday and Tuesday, and today fairly flat, even though it was an up day. So starting to neutralize with the slight bearish read here on today's session, even though it was an up day. So that to me is important and a step in the right direction to neutralize this overcorrelated state. Remember that if we can get neutral, that indicates that we can see rotation throughout the sectors, and rotation is what keeps a market trend alive. This overcorrelation, it really just leads to volatile and choppy conditions, up, down, up, down, up, down, which is what we've been seeing for like the past week and a half or so, right? So steps in the right direction, confirmation, I should say, of the move higher based on significant inflows, and the tick also supporting that idea as well. So those are the market internals. Let's take a quick peek at the market profile, which is over here. No big takeaways on the market profile. We don't have a poor high. That seems fine to me up there. Slightly poor low, but if I zoom in, we might have a couple ticks of excess. Yeah, look at that. We've got 3 ticks of excess at minimum. It's probably more than that. So I would not classify that as a poor low. One interesting thing is that your point of control has been overlapping here. So all set from that perspective, indicating that value truly is up here towards the highs and not really, somewhere down underneath us. One thing to bear in mind and carry forward is that we have one virgin point of control down here, but it's not like we're stacking these up aggressively, right? This is the only one that we've kind of got. The day before that, we tagged up. So from a, naked point of control perspective, this does not seem like we are getting overextended to the upside just yet. Another takeaway, just as a very brief one, right, is that we did have a string of single prints on the Tuesday session. Technically, we opened and sold off from there, right? But again, did we get any acceptance in the gap? Not really. No acceptance in the gap. We rallied back higher and obviously closed firm with a point of control that did migrate higher with price instead of being left somewhere low in the overall profile. And by the way, if you weren't familiar with any of those references, I've got another video tutorial for you in the top right-hand corner. Overall, the takeaway from the market profile is bullish with the point of control being left high in today's session. With all of that being said, let's get back on over to the platform and round out the broad market with our QQQ. The psychology will remain mostly the same for the QQQ and the IWM. So here we go, zooming in, making it center stage. What do we see underneath us? More of a full gap fill, honestly, in the QQQ. But most importantly, here's the balance range. Where did we close, right? Obviously, it was back above. So we looked underneath. We failed back into the Tuesday range. So the gap was filled. The structure was repaired. The sellers did not get any price acceptance underneath that 279.54, 279.50 level, top of balance, and instead we closed back up at the highs. So going forward, it would strike me as bullish here. If we can take out this 282.85, looking for 286 on the backtest of the FOMC breakdown, and anything further than that, we've got 291.25. If we fail back down underneath that level we just discussed at 279.50, that's where I would look for the look above and fail to really, start to materialize. We talked about it in the SPY, right? It would be volatility. Here is your look below and fail. Here is your look above and fail. If we can get a daily close back underneath that level we just pointed out, 279.54, and the target would be the bottom of the range here at 272.65. So one step at a time. The chart does seem to be striking me as more bullish than bearish based on all the psychology we've talked about, and those are the numbers. Next up is the IWM Russell 2000 and the small caps. This is the most bullish chart of all three of the indexes because it never made the move into the June lows. It never broke down from its balance area here. Monday was just a hammer candle that failed at the bottom of the range, closed right at the top, gap up, partial gap fill today, inside bar closing back in the range, failure from the sellers. Everything's basically the same, right? I wouldn't necessarily be pushing my luck to the upside because 177 is a pretty critical overhead resistance. That's where the breakdown came from when the IWM played quote unquote catch up to the remainder of the broad market. So I would watch for more sideways price acceptance up here at the highs with a slight bullish edge based on all of the psychology we've discussed so far. The only time to get bearish again in the short term is if we are clearly failing here, then fine, you're technically looking for your lower high outcome. If you see like a big rejection happen off of 177, then yeah, maybe there's a reason to get short up against that level. But based on the psychology so far, I would say bulls kind of in control. I wouldn't really be aggressive with the short. Maybe it can turn into a big swing trade where we do make the equal low over time. But definitely, if you're going to do something like that as a swing trade, buy plenty of time and keep your expectations low. The time where bears start to feel more confident is obviously back down underneath the top of the range at 169.20. That is the IWM. Let's blast through the core list of companies. I'll get you those trade ideas and send you on your merry way. Here's Apple. Very interesting chart with the breakdown and very quick snapback. The place that we're looking for possible shorts is up against the breakdown level at 148.75. If we come into that and start failing, that would be a reasonable place to look for some shorts to the downside. We could be putting in a lower high on the daily time frame off of that level. Same concept as what we just discussed in the IWM. Anything that remains sideways in here, that to me would be an indication of higher price acceptance. And then we're looking for breakouts instead into the 148.75 and possibly follow through after that. That would really require maybe another day or two as a bull flag. It would turn into an hourly bull flag, 4-hour bull flag, whatever. And then you can see that follow through. Obviously, if we breach the lows at 143.40, kiss it goodbye for the equal low down here. That's a poor low around 138.25. Next up, we've got Netflix. Incredible relative strength out of Netflix just on a, quite literally a relative basis. It's still hanging out up here at the highs, never even came close to the June lows. What happened on today's session? Big breakdown of not only the 50 SMA and our level here, or I should say not only the 50 SMA, but also our level here at 234, and then an impressive snapback into the close, right back above that level. So a test underneath all of these lower wicks, sellers absolutely failed to keep prices lower, and we snap back higher. To me, it's pretty solid evidence of a higher set of lows starting to build out. And of course, our next big trade in Netflix is, can we get price acceptance over 250? We've got an 80-point gap overhead. Remember that you don't have to be the first one in the door. You can wait for a bullish trend to develop above 250 and then pick your entry. Okay, so something to consider, that you don't need to just be blindly starting to long this thing, because if we fail, and let's say earnings are a catastrophe, who knows? Maybe we do something like this. So one step at a time. I definitely want to see some confirmation over 250 before we get ahead of ourselves. We've tested this thing so many times. You know, at a certain point, it's like you knock on the door, eventually someone's got to open up and let you in. But, you know, could it be a failure is the possible question you have to consider. With earnings around the corner, I would want to see some confirmation. So just being very cautious around that 250. And as I've been saying for the past, multiple weeks, really, you don't need to be the first one in the door. Let the trend develop first. Here we go. Tesla. What's going on in Tessie? Very, very bearish price action, but you can see multi-day balance, and we did print a hammer candle on today's session. So on the breach of the 2-day balance right here and the sell, if the sellers were going to materialize, we should have seen a firmer close outside of the 2-day balance. But instead, we landed right at the bottom. So what I would watch for going forward, and perhaps better illustrated on the intraday timeframe charts here, is if we can get a move back above today's opening print where we sold off from, you would watch for move over 244.75 to rotate to the top of the balance. What would that be? Look below and fail, right? That's the pattern we just saw unfold in the S&P 500. Your target would be the bottom of the gap at 256 even. So that is the daily time frame or hourly time frame on the upside for Tesla. If we just fail here, then sideways and a breach of 232.25, your next short trade brings you into 219 from these sets of lows over here. That's what I would watch for into the end of the week. Google. This one's putting in a nice little 2-day balance after filling the gap underneath. By 2-day balance, I just mean the two equal highs are stacked here. A breach of 101.75 gets you to 103, then looking for follow through to the upside. These two highs at 105.25. Just thinking from a range perspective, there was a balance area. We closed the gap, repair the structure, and close back firmly outside of that. So to me, buyers kind of seem more in control than the sellers. If the sellers were going to do it, again, they should have closed the gap and kept prices underneath $100.50. Next up, we've got Meta. What's going on in the metaverse? This one can't get out of its own way. So as the remainder of the market was kind of bullish up here across everything that we've seen thus far, Meta is still in the range. So very, very simple. Longs over 141.65, shorts underneath 134. Daily hammer candle is in place. So I would favor some upside here into the remainder of the week if we can get over that 141.65. It does seem that the buyers responded to those lower prices. Next up is NVIDIA. This one is much more like Google. So here's your balance range, right? Sellers fill the gap, buyers respond, and we close firmly up at the highs. It's an outside bar, watching for some follow through into the intraday level from here. It's in that upper wick at 135.50. Let's call it 135.50 even, and then looking for follow through a little bit further than that, which is coming from right around in here, right? And that's going to be your 141.25. This chart does strike me as being fairly playable and also bullish into the end of the week, just based on the gap fill reversal and closure up at the highs right at the level. So watching NVIDIA for some upside. Anything that pulls back and goes sideways is neutral. Obviously failing the wick at 126.85 here is bearish. Next up, we've got Microsoft. What's going on in Softy? Never even, it scratched at the gap, barely even getting any, no sellers, complete failure there. Nothing going on from a sell side perspective. So if we can clear 249.75, you can see the range does open up into 256.85. I would be watching for that, and we are coming out of a balance breakout. So let me just quickly point out, we have quote unquote hit the target from the balance breakout. The next one would be, all right, here's your 2-day range. If we double that, we can kind of see that makes sense as a target at 256.85. Might it require some more time? It's possible, but based on the failure from the sellers, strong close, you guys know the story by now, it would make sense to me that this could see a breakout into the remainder of the week, or at least be neutral and sideways. Unless there's some really bad news out there and the market gets, driven in one direction versus another via news, I think that all of the charts for the most part are pointing in the bullish direction just based on what we know from psychology and sort of structure. Now, granted, when I was bullish last Wednesday, the market did the exact opposite. And hopefully I've done a good job in saying, if we break these levels, then look for this. And the psychology makes sense, so we can expect that. But we have that NFP coming out on Friday, which has hopefully balanced out the analysis here and saying, okay, the charts look bullish, but we still are not out of the woods from a volatility perspective. I do want to throw that in there again, just because being overly bullish and married to bullish outcomes, sometimes that doesn't serve you so well. So charts do look good, but take that with a grain of salt given the volatility in the marketplace thus far is what I'm getting at, right? I don't want to get caught in the same cycle as what happened last Wednesday. Amazon, hourly double bottom, right? Same thing going on. Opened a little bit opened in the gap. Sellers, no filling of the complete gap, filled the overhead gap and closed in the prior day's range. The issue with this one is the upper wick from Tuesday's session clearly rejecting this level right here at 121.50. So to me, it's got to be a higher low above that at this point in time, or at least intraday acceptance above to start looking for some longs. Anything that just stays neutral in here is exactly that, just more neutral. Sure, we're outside of the range and it's a step in the right direction, but there's no obvious long until there's price acceptance over 121.50. So that has been the core list of companies. Let's blast through these trade ideas. Shop is up first. Shopify has a beautiful inside bar setup. Looking for a 1, 2, 3, right? So can we break those highs? Let's go ahead and draw in some price levels here. Taking out 31.50 roughly does get bullish into, I would watch for the green bars high right here, around 33. So, not the biggest range to be trading for, but the setup does strike me as bullish, especially on the hold of getting out of this prior range here, right? Big, aggressive bull bar, little resting bar. Can we get some follow through is the question on a breach of the highs. So Shopify, bullish, want to see it above 29.15 to continue to watch that trade. WFC Wells Fargo is up next on the bullish inside bar setup. This one's attractive because we've got the 50 SMA right there as well. A breach of both of those levels should get us closer to that 44.50 mark. So as a nice little intraday trade or possibly a 2-day swing, I don't know how you want to play it, but the setup is there nonetheless, breaching 43.50 to get to 44.50, about $1 worth of range to trade for, and you want to see it remain above today's low at 42.50. So right on the numbers, about $1 on either side of that area of interest. So that's Wells Fargo, bullish. ABNB, Airbnb is bullish as well. Reason being is that we've got the partial gap fill underneath, right? Hammer candle printed closed outside the prior day's range, Tuesday's range, and looking left, we've got pretty thin structure from the breakdown right in here. My target would be up around that 116.63 on more follow through up and over 112. We'll call it for round numbers sake. If you want to pull it off early around the 50 SMA, I wouldn't fault you for that. And anything that just remains sideways in this range is not necessarily playable. I would want to see the momentum continue to the upside, holding this unfilled gap based on today's lower wick. That is Airbnb. Next up is Coca-Cola, KO. What's going on with Coke? It's another bullish trade idea. Can you believe it? This one, though, is more interesting because today was the breakdown of the levels, right? You can see that we had a bear flag here. We breached the levels, and then we closed back inside of the flag. So is this going to continue higher is the question to ask. There's two different entries. You could either take it long over the hammer high and target the inverted hammer high, or if you want to be a little bit more skeptical, you could wait for the breach of the top of this box. Let me go ahead and give you some numbers here. So there's the top of the box, 57.18. You still have to contend with that upper wick there, but ultimately looking for the back test of this. If you're waiting for the more patient, over the balance range up into the back test of the breakdown, that's one possibility. And of course, you're just not interested if we never break to the upside in the first place. The hammer high, by the way, is 56.65. Not interested in the trade if we fall underneath the bottom of the flag again at roughly 56. Last but certainly not least, we've got DIS for Disney. What's going on with Disney? You can see a very similar setup. Most of these things look similar out there in the marketplace. Inside bar, hammer, looking left, there's thin structure until we get to the back test of the breakdown at 106. What's the breakout level? 101.40 roughly. So this is kind of what we're looking to trade through on relatively thin structure up and over this setup high. So to me, bullish setups out there in the marketplace. If we see a big fake out, big move up and over, we know that, okay, volatility's high. Maybe it's a fake out. Don't go in with massive size on any of these trades. Keep a tight stop loss. Still recognize that, in the grand scheme of things, high, lower high, this could be a lower high. this could be a lower high, right? So I want you to keep a balanced approach as we're still trying to resolve some of the massive volatility out there, which is evident in the VIX. That's ultimately going to wrap up today's episode. If you enjoyed it, let me know down below in the comment section or by giving the video a simple thumbs up. Also, let me know on the new format with the SPY technicals up front and then the sectors. And with all of that being said, I wish you a green trading week.